Okay, so today's video is the second in our 10-part series entitled Huge Options Trading Blunders. We decided to produce this series for traders who are really serious about trading options for a living and taking the proper steps to excel as an options trader, as opposed to fooling around with ridiculous trading ideas that have giant hidden risks that are often overlooked. I'm the head trader of SMB Capital's options trading desk, and I can tell you from many years of experience that the pitfalls we're going to be describing in these videos are real. And if you're serious about trading for a living, you really need to pay close attention to these videos so you can avoid serious problems in your trading journey. So if you're committed to changing careers and trading full-time as an options trader, then I urge you to watch this video and the rest of the videos in this series so that you don't fall by the wayside like so many aspiring traders who don't want to spend the time to learn the actual truth about the challenges and rewards of options trading. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so today we're going to continue our series of options blunders and myths that we're trying to debunk and warn you about so that you can avoid dangerous options trading situations. So in today's video, we'll be talking about this crazy myth about options trading that somehow is circulating around the trading world, and it goes like this. I bought a call option on Facebook right before earnings, and I sold a Facebook put option for the same price, so I own the call for free. Now, we need to break down exactly what that statement means, and then we'll delve into why that concept is so insane and dangerous. Now, most of you probably know something about options, but just for a quick review, and this will be fast, what is known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares. Or conversely, on the put option, if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which of course saves him a lot of money compared to where he did not own the put and he's stuck suffering a much larger loss on his shares because their price has gone way below what they were worth before he had no protection against that happening. So those are the basics of call and put options. Okay. So let's look at an example now of a real life situation that you could have gotten yourself into if you didn't know better. Here's Facebook trading at 217 a few years back. At that time, that was an all-time high. And so let's say you were bullish on this stock and felt there was more upside. So on this day, as you can see, you could have bought Facebook 220 calls for $2.80. And if you look down on the put side, you'll see that the 210 put happens to be priced for exactly the same price, $2.80. So you figured, hey, I'm bullish on Facebook and I can buy that call for $2.80. So since each of these call options represents my right to buy 100 shares of Facebook at $2.20, I'll pay $280, which is what the $2.80 represents. At the same time, though, I'm selling the 210 put option, which happens to be at the exact same price as the 220 call on this day. And so in this case, I'm going to receive $2.80 times 100 for the 100 shares that each option represents. And so I'm going to receive $280 for selling that put. So the cost of the call was offset by the cash we received for selling the put, so we own the call for free, right? I mean, after all, there was no cash flowing out of my account after this transaction, right? I mean, everyone loves stuff for free, right? But this is a ridiculous concept that misleads people, and we've got to work through why this concept is very, very misleading. Well, first of all, you could say that there are a lot of things you can get for free. For example, suppose I have a ticking time bomb in my hands. I could give that to you for free, right? So now you have something for free that could blow you into the next county, but still it's for free. So it's not necessarily good to have something for free, but just because something is free of cash flow doesn't mean it's free of risk. And that's the fallacy of this concept that you're about to see a vivid example of. Now, before we get into why it can sometimes be a very bad idea to own an option for free, I wanted to let you know that there really are sound techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of the strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those are strategies that would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing right now at the top right corner of your screen. That will open a free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so here's the thing. Traders find the idea of buying a call very attractive because it helps them to control the risk of a trade. So when you buy the call for $2.80 here, in other words, you spend $2.80, and if Facebook doesn't get beyond the strike price of the call by expiration day, then the call just expires worthless and you've lost $280 and no more. Now, I know you don't get into trades to lose money, but the fact is that the worst it can get for you is the loss of $280, which is what you originally put up to buy the call. But then when you try to get cute and you don't even want to pay $280 for the call, you want to pay nothing for the call and have it for what you're calling free. And here's the important part, so please focus on this. At that point, you've completely changed the risk-reward dynamic of the trade. Now, why do I say that? Well, that goes to the fundamental nature of options. A call option is a right to buy shares. So the worst that happens is that you don't exercise that right because Facebook never gets beyond 225 and the call never has any value because you're not going to exercise your right to buy shares at 225 when the stock is trading for less than that, obviously. So you don't exercise that right and therefore you just blew $280. But if you've also sold that put, then while you may feel better because there was no cash outlay for the call and you could make a lot of money if Facebook rallied quite a bit, you inadvertently took on a huge risk that you weren't thinking about, all because you were trying to avoid shelling out $280 for the call. So let's take a look at what actually did happen on this trade. So as it turns out, Facebook sold off badly. And on the day the option expired, Facebook closed at 174.89, about 43 points below where Facebook was trading when you entered the trade, and worse, 35 points below the strike price of the put we sold. So let's break down how this trade ended. So remember, we started out with zero cash outlay because the price of the put we sold offset the cost of the call we bought. Well, that was where the good news ended, because with the stock selling off to 174.89, the owner of that put is obviously going to exercise that put at 210 because the shares he has, which are now worth 174.89, he can sell them to you for $35 per share higher than they're worth. So he can dump his shares on you for 210 and you'll be the proud owner of 100 shares of Facebook stock for 210 when they're trading at 174. So you immediately take a loss of $35 per share. The crucial takeaway here is that the trader did not at all appreciate that by being able to go around bragging to his friends that he was able to structure a trade where he bought a call for free, he put himself into an incredibly dangerous position because he didn't think through the fact that he had completely altered the risk-reward nature of the trade by selling that put. In other words, to save himself a lousy $280 on the call, he put himself into a position where he lost over $3,500. In other words, he took a limited risk situation and turned it into an extremely risky situation by virtue of the fact that he didn't realize that the risk of selling the put was, in a sense, the cost of owning the call for free. He was trading upfront cost for a huge risk, and all he was thinking about was how he drove his upfront cost down to zero. Look, I used to be in the insurance business and we insured people's houses for fire insurance. So suppose someone asked me to insure their house, which let's say it's worth $100,000, and they wanted me to insure it for $500. And I took that cash and I bought a lawnmower for $500 with that cash. Did I just buy a lawnmower for free? Well, kind of. I got cash from you and bought the lawnmower and ended up with the same amount of cash as I had before you gave me the $500. Yet I'm up one lawnmower. But I'm on the hook for $100,000 if your house burns down. So did I get that lawnmower for free? This is the same thing. When you sell an option, you're entering into an obligation. If you don't understand that obligation, you have no business trading options. What was really wrong here was not that the trader made the trade. The problem was that he didn't understand the implications of the risk of the trade, which he had no business doing because he didn't understand what he was doing. So the moral of the story is that you have to look at the full risk-reward picture of every options trade. You can't just look at the upfront cash flow of the trade without understanding the risks of that position. In this case, you took a $280 risk and turned it into a risk more than 10 times greater than that because you didn't understand the ramifications of selling that put to put yourself into a cash flow free position. Just looking at the cash flow is extremely foolish, and it's a really good way to turn a large fortune into a small fortune. Professional traders, the ones who do this for a living, hardly even acknowledge the cash flow aspect of an options trade. They focus on the full risk-reward trade-offs of the option strategy that they're implementing and then take sensible steps based on that risk-reward profile. If you want to become a professional trader, that's how you'll need to think also. So by now, I hope that you see why we call this an options trading blunder. And to be clear, it's only a blunder if you don't understand the risks you're taking on. If you're bragging about the zero cash flow of owning the call, then you are most likely not understanding the risk you've taken on, and you shouldn't be in the trade at all. So don't fall into this trap. It would be a sign of unprofessional trading. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, and you'd like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please, don't forget to click on the subscribe button right now so you won't miss the next episode of Huge Options Trading Blunders and all the other free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.